Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, are you looking to expand and grow your business? Are you looking for that edge, that next step up, that paradigm shift? Well, one of the best ways to get you there is through a mentor or a coach. And today's sponsor, Trevor McGregor, he is the man. He is going to get you to be laser focused, to get you onto that next level. And I know from experience dealing with Trevor, he is a master coach, peak performance coach, well over 10,000 coaching hours through clients all over the world. And he helps you achieve better health, more wealth and freedom and contribution than you ever thought possible. Have that coach that holds your feet to the fire. Go on to Trevor's website, coachwithtrevor.com. Again, it's coachwithtrevor.com. And there you can get a free strategy session with Trevor. And you can decide if he's the right fit for you and you're the right fit for him. Again, it's coachwithtrevor.com. You will not be disappointed. Hello and welcome to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. I'm excited for another great episode. With me today is Ian Colville. And Ian is the managing partner of Carpathian Capital Management. Ian is a native of Minnesota, born in Rochester, and he has been kind of all over the banking world. Is that right, Ian?
Yep. Spent a lot of years in banking.
So spent a lot of years in banking. You were over in Russia for quite a few years doing banking and got into real estate investing as well, I believe, while you're over in Russia.
Yep, that's correct.
And so I'll let Ian kind of tell us a little bit more about his background and just how you got started in business.
All right, awesome. Todd, thanks for having me on the program. I really appreciate it.
Yeah, thanks for joining me.
I'm from Minnesota, but you're right. I ended up taking a 10-year detour through Russia. That plays sort of only a side role in terms of what I'm doing now in real estate. But in the late 90s, early 2000s, I headed off to business school in Philadelphia. 2001, when I graduated, it was 2003 actually. When I graduated, it wasn't too far after 9/11. So, whereas New York might have been a natural place for someone who wanted to work in finance, I did have a job offer, but it wasn't as rich as I might have hoped at the time. I also spoke Russian. Just learned it in college and had spent a year abroad during college. So I decided to go refresh those skills, and I ended up getting an internship doing some financial modeling for a guy who was building warehouses over there. Thought I was going to be there for 3 months, but ended up coming back 10 years later with a wife, a daughter, and a whole container full of furniture and other things accumulated over the years. So I worked for a couple different banks. I ran equity sales for Deutsche Bank and Citibank. The biggest impact biggest role that's played in the real estate career that I now have is that just allowed me to meet a fair number of people who are active in the financial world. A lot of them turned into my investors now. So getting into real estate a little bit, it was around 2012. I was still working in Russia, but we had a lot of clients here in the States. I would come back to the States once a quarter to visit with the banking clients, and then I would also take a side trip through Minnesota, see my family. And this was, of course, just after the recession. So I started buying properties as kind of a hobby, maybe it was a retirement plan. I didn't really have something big and bold mapped out at that point. Ended up after a year or two of that with something like 2 houses, two townhomes, and 2 fourplexes. So that turned into a nice little portfolio. Then I had a couple of buddies who also wanted to invest. And I was thinking about expanding a little bit, although I was still working in banking. So I just brought them in as partners on the properties they already owned. So basically I sold each one of them a third of the LLC that owned those properties. That was my first experience with managing properties and outside investors.
Hmm.
And then right around that time, Citibank, where I was working, Russia wasn't recovering the way we had hoped after the recession. So I had an opportunity to take a nice severance package from Citibank and go do something else. And since I'd had this, I was enjoying the real estate that I'd been doing kind of as a hobby. I decided to turn it into a full-time job. So I threw it. I certainly didn't know that if I was going to be successful or not, but I threw together a PowerPoint, showed the 6 or 7 properties that we had as my track record, kind of track record. I put that in quotes, and was fortunate enough to be able to raise $5 million from just the folks that I had met through banking. It was timing played an important role too. It was obvious, everybody in the world pretty much knew that U.S. real estate was cheap at that point. Interest rates were very low, and then there was some concern about central banks printing money around the world, and that traditionally has led to inflation. It hasn't in the U.S. case, but at the time, nobody knew that was going to happen. So when you've got a cheap asset, you can borrow with low interest rates. And in theory, when inflation hits, you want to own something like commodities or real estate. And that was just another sort of hook I was able to use to get people interested. So I think that the money I raised was certainly people had known me for a while, et cetera. But if I had been selling, I don't know, widgets or some sort of, or hoverboards or something, I certainly would have had much less success. I was selling something at a time when people were interested in it.
So take us through that first raise that you did. Did you do it as a securities raise, a full syndication, or was it just kind of more handshakes? How did that look?
Yeah, we can get into you be my guide here. Let me know how far you want to go into the technical details. At some point, if you're just putting together 3 buddies and buying some properties, that probably does not qualify as a syndication where you're doing general solicitation. These are all sort of SEC regulation words that I'm using. So that first vehicle where I brought in 2 buddies into my LLC, I didn't do anything more than just draft up a few words on a piece of paper and everybody signed it.
No.
When you're doing, at some point though, if you want to do something bigger, it turns into something that the SEC might view as a little more serious. And I don't think there's a bright line for that. I'm not sure if it's like if you're raising more than 500,000 or you're bringing in more than 5 people. I believe I've asked the lawyers that, and nobody can give me a specific definition of when it switches from friends and family to something serious. But somewhere along the way,
yeah, I think it's more if it's completely passive for the investors, then it's a securities. If they're also involved in it, and they're it's more of a joint venture, then you could consider it not. But especially like you said, once you start getting more than a few people involved, you should probably look at
there may also be some component of how well do you know the people that are bringing in. Certainly, as soon as you start bringing in strangers, you're kind of in a sales process. The SEC might want to have some influence over. So this is getting way into the weeds here, but there's 2 kinds. There's generally there's more now, but then there was generally 2 kinds of placements that you could do. Actually, no, 506C didn't exist at the time. That was since then. So we did what's called a 506B placement, which is you put together a private placement memorandum. You notify the SEC that you are doing this, but you get an exemption from their regulation if you agree to. I think you have to stay under a certain dollar amount, but you also have to agree that you're only going to solicit money from accredited investors, which is a technical term for people who have a certain amount of assets. I think it's something like $1 million in investable assets or $200,000 a year in income.
Yep.
The SEC is created. Well, I'm not sure that's law or that's an SEC interpretation of the law, but that's out there. In theory, that if you have money, the SEC believes that that person is sophisticated enough to make a decision about a private investment, like what I was doing, and therefore these private they don't require us to submit financials every quarter like they might for a publicly traded company that anybody can buy. So that's what we did. It was a 506B placement.
Okay. So then when you did that and you raised your $5 million, what did you buy?
So that we call that our first fund. That entity, 5 million in equity, 4.7 to be exact, and then we borrowed a fair amount from the banks. So we spent around 17 million. Those properties are maybe worth low $20 million today. Bought an awful lot of houses. That's where we started. We started with houses. I mean, I was a banker who was getting into real estate, so. And that happened to be the asset class that was cheap as well. But I wasn't. We now own offices and some larger projects. But back then I wasn't comfortable doing larger projects.
Yeah.
Bought a lot of houses. We did end up buying a 36-unit apartment building, which did very well. So it's all residential, mostly houses. We have some duplexes and fourplexes, and then 36-unit apartment building. And we ended up buying in 3 geographies. We bought in Minnesota, we bought in Quad Cities, which is a smaller city on the border between Iowa and Illinois, and we bought in St. Louis as well.
Okay. Did you buy some stuff in Detroit? For some reason, I thought you bought Detroit.
Oh, yep. So that's a little more recent. After we invested that first fund, I went out and raised a second fund. So raised another 5 million. And that fund now owns a similar amount, we spent something like 17 million. And as part of that second fund, we ended up buying 30 houses in the suburbs of Detroit, not in the city proper. We learned a few lessons in the first fund, and we just decided that we wanted to have a more expensive class of house if we're going to be buying outside of Minnesota where we're headquartered. They're just easier to manage.
So take me through that, because that's you guys bought a lot of houses, and houses are difficult to manage. I manage a small portfolio compared to that. And they're all located in the Twin Cities, and even that is somewhat difficult to manage. So take me through, how did you set up your team and management, and what did you do? What did that look like?
It's still a pain in the butt. Even we've got 300-400 houses right now. But there is a kind of a tipping point where you reach a certain amount of scale. And it's probably at the 50 house and above level. And that's the point where you can afford to hire somebody on your team to start to take care of things. Up until that point, it's fairly painful, but you need to. I don't know how else to put it. So in the early days, it was just me, and I made all the buying decisions, but I then hired outside third-party managers to do the day-to-day management of the properties. And that was okay, but I never really had the visibility into how the properties were being managed that I wanted, being a little bit of a control freak or control oriented anyway. So once we got large enough, I hired somebody, and we have our in-house property management group. And we slowly transitioned away from the 7 or 8 external managers to now as a professionally managed internal group. So I've brought in a partner who's my COO, who's excellent. He's very detail oriented. And then we have a full-time property manager here. We have a full-time property manager in Quad Cities. We have part-time folks in St. Louis and Detroit. We have full-time maintenance manager here. Then we have a number of 1099 contractors that handle maintenance for us that do a fair amount of work for us, but they're independent and they do work for other people as well. So, but we do own a few apartment buildings, like I said, and we own 3 office buildings, and there's no question that it's easier to manage the larger assets than it is the houses.
When you're looking at you can pick whatever geographical area you want and whatever portfolio you want. But when you look at your portfolio of single family houses and you compare that to, let's say, that 36 unit apartment building, or maybe one of your favorite commercial buildings, and you can look at profitability, return on investment, do you see a big difference there, or what was that?
Yeah, the multifamily here in Minnesota, I know you're buying some multifamily in other parts of the country, so I can only speak to multifamily here in Minnesota. And I suspect it's true in many other markets in the country. Prices now have just gone crazy. Like I can't buy, we paid, I don't know, $45,000 a unit for our apartment, 36 unit apartment building. That was back in 2013.
Is it the Twin Cities?
Yep, Twin Cities, Brooklyn Center. We put $10,000 a unit into it. We put in granite and really some nice accents. And then we raised the rent. We were able to increase rents by about 30%. I don't think you could buy that type of building for anything like that now.
No,
so
you'd probably be
80,000 a unit, 90,000 a unit, that type of thing. Probably cost twice as what we paid for it. So profitability is all relative. Can somebody replicate what we did with that apartment building right now? Much harder to do, but that asset ended up being one of the most profitable projects that we've done. And I think that one of the, although we have renovated houses and raised rents, etc., but one of the keys for profitability, at least in terms of the investors, is leverage. And it's actually slightly easier to borrow money for large properties than it is for small properties once you get beyond, say, 4 houses. If you're buying somewhere between 4 and 10 houses, you can go get a traditional mortgage, Fannie and Freddie, government guaranteed, and that might be a little bit easier process. But once you get above 10, then you're dealing with the commercial lending branch or group at a bank, and those bankers are looking at your 15 house deal, and they're also looking at the $3 million office building down the road and the $3 million apartment building, and they're going to pay a lot more attention to. It's a lot easier for them to underwrite an apartment deal because it's just one property versus underwriting 15 houses. So what really ends up making a lot of money and a lot of value for investors. You buy something, you fix it up. You buy something, you use leverage to buy it, and you fix it up, and then you refinance it. Once you fix it up, it's worth a lot more money. So you get it can support a bigger loan. So a lot of times you can get that second loan will be large enough that you're getting all of your equity out of the project, but you still own the property, so you're collecting. Your mortgage payments is a bit higher, obviously, but you're structured in such a way that you're still getting cash. So you've gotten all your money back, plus you're still collecting the rents on the property. And that is what we did with the apartment building. We've been through, we refinanced that once and we've got all of our money back out and then some, and then we're still collecting the rents. Whereas with the houses we own, I was able to rehab and refinance that apartment building with over like a 2-year period. Whereas we're about 4 years into the life of our first fund, and I'm just now starting to refinance the debt that we have on the houses. It just takes longer. It's a little bit more difficult. So while we may have raised rents in a similar fashion, that refinancing process is just a lot easier with large assets.
So Ian, the first fund, it was a fund because you just raised $4.7 million.
Yep.
And then the investors trusted that you would go out and buy the right assets.
Yeah, it was I sometimes called a blind fund. Now the word fund, let's just be clear, it was just a multi-member LLC is the legal structure. Called it a fund. I've got 30 investors there. People tend to like that word, but it's not a mutual fund that you can go down to Fidelity and buy shares.
Right. But these investors, I mean, they trusted that you're going to make the right decisions. You showed them a model, and they based it off that model, which is pretty impressive. Actually, really impressive for your first raise.
I always believed in myself, but I too am a little, pleasantly surprised at what we were able to achieve then. I think that
maybe you were too naive to even think that it was not that hard.
I don't know, but it was folks that I'd known for quite a while.
Yeah.
I had paid my dues by working in banking for 10 years and had been sort of a steady performer in banking, and these were all like a lot of them were former colleagues, etc. So they got to see how I was working with the bank's clients, and I think I generally had a steady reputation, and people felt like I was going to do my best. I was going to do my best to invest the money. It was an asset class they were interested in, which helps a lot, and an asset class that was hard to get exposure to. You couldn't just, at the time, you couldn't go buy into a REIT or something that owned a bunch of houses. So, but yeah, I mean, raising $5 million was,
that's a fantastic feat.
A blind fund like that. I did the second fund. We did a little bit of crowdfunding for the second fund.
Oh, you did?
Which is, it's just, I view it as just using a website to do the same thing that I was doing anyway. So I was able to bring in my own investors. They could sign up on the website, and I was introduced to new investors who could sign up on the website. It's not all that different from what we did initially, but it's certainly easier to raise money for a project if you already have the project in hand. If you have a property under contract, even if it's just one house, it's a hell of a lot easier to raise money. So that's not the way we did it, but if someone's trying to get started with raising money from other people, if you can have the property in hand.
Yeah, and that's how I've done all my deals. I've never done, like you said, a blind pool like you've done. So on your apartment building and on some of these commercial deals, is it still off of, quote unquote, one of the funds, or is it, are you raising it per project?
Now that we've grown a little bit, I've switched over to doing a few things on a per project basis, which again is easier. That first apartment building was part of Fund 1, but we just bought, in January now, we bought 2 buildings. We bought 70,000 square feet of office buildings spread across 2 buildings, right on one of the major highways here in the Twin Cities, which is 494. And near to Highway 100 for those of you that are from the area. So that was about we bought the buildings for just shy of 6 million. I think it was 5.7 or something. And then we had to put a lot of money into them. So on those buildings, I put them under contract, and then I flew around the world raising money just for this project. I'm sitting in one of the buildings right now, so just for these office buildings. So I did an asset specific raise, and it was definitely, I don't want to say it was I did have a track record by then, but if I had to do it all over again, I would recommend someone start with an asset specific raise as opposed to a blind pool.
So you flew all over the world to do this raise.
That is, we ended up raising $3 million, which
$3 million. Okay.
For most people, you don't need to fly around the world to do that. But it just happens that my contacts were all expats like myself that I met living in Russia. And if you can believe it, none of them were polite enough to stay in one place. So it's just the people that I know because of a prior job. It's not that.
Yeah. Do
not think that you need to fly around the world to raise money for your projects. Just raise it from friends and family. So basically, that's what I was doing.
That's what you do.
I was visiting my friends and former colleagues, but the British banker had since moved to Hong Kong, and the German hedge fund manager was back in Germany. So I had to go see him.
That's too bad. So you get to travel the world.
Oh, it's business travel. For anyone who's done business travel, it's exhausting.
It's totally different.
Yeah, especially when you're changing time zones. I was a zombie. I would wake up and
I can imagine.
Yeah.
When I drive to or fly to Cincinnati or Lexington or whatever, and I come back and I'm just dead to the world the next day. It's like, geez.
Our bodies aren't made for it. No. I love seeing the people, but the bodies are not made for it. I got sick for a week once I was back.
Funny. So Ian, what's one of the biggest mistakes you think you've made in this business?
Um, there's always things that I would do differently, and there's always things that, uh, in retrospect, weren't mistakes. I can tell you about the most expensive issue that's popped up, and that was with our third-party property managers. Traditionally, the way these managers work is they collect the rents from your tenants, and they hold them in their bank account until the end of the month or so, and then they send you one check at the end of the month. Um, and that was all fairly normal and routine for houses. Now that I've moved into larger properties, I've since learned that larger property owners oftentimes have more controls in place where they control the bank account where the rents are being deposited. But we had a property manager in the Quad Cities who pretty much went out of business overnight, and we ended up losing $100,000 and $120,000 in rents and damage deposits. So that is something that I will never do again, is allow a third party to hold on to my money even temporarily.
Wow.
So we now manage all of our properties, so there's that problem got removed anyway. But property manager who was holding 40,000 damage deposits, and then was a little bit slow in paying out the prior month's rents, and it was into the beginning of the second month such that she had collected a lot of the second month's rents. So we ended up losing 2 months of rent.
Wow.
Trust but verify, I guess, would be the lesson learned there. To quote Ronald Reagan, is don't let it get so far gone and that you can't recover from it. Unfortunately, it didn't get any further gone than a couple of months, which we were able to recover from. But if verify, in retrospect, I would have had the damage deposits in my account, and perhaps even the rents.
Well, and money does funny things to people sometimes, and like you said, trust but verify. That's probably been some of my biggest mistakes, is just trusting that people aren't going to take your money, So.
Yeah, unfortunately, but so especially, this is no longer has to do with this property manager, but in general with new relationships, just check everything you can along the way. Trust builds over time. You don't have to trust on the first deal.
Yeah, absolutely. Tell us about your goals. What are your goals moving forward? What's this business going to look like in 5-10 years?
I really value the independence that running my own thing has to offer. So while I had a great time in banking, I'm having an even better time just running my own business. I'm an investing junkie. I think that real estate is very interesting, as it's full of what in the banking world we call special situations. There's always an opportunity to dig in and find some weird situation where you might be the only guy who can think of a solution, and therefore you can make money. So we've added to our business. We're certainly going to go out and do more projects, raise probably more larger deals like the office buildings, etc. We've also started lending some money recently as well. We do what's called private money lending or hard money lending. The investors that we have like the long-term projects that we have. If you come into this office building investment, I probably would have told you that you plan on your money being locked up for 5 years. Investors like that, but they also have some portion of their money that they need to keep more liquid. But they wouldn't mind, investing it for 6 months or 12 months. So we've added the hard money lending to the business, which is exactly that. Come in and lend on this fix or flip. And it's a good place for us to be because we understand the collateral. We own houses ourselves.
Yeah.
So hopefully our borrowers value that experience. We can talk to them about what we've done in similar situations, what contractors we've used, etc. So I think we're going to be doing more large single asset raises, like with these office buildings, and the hard money lending is going to continue to grow as well. And then from there, we'll see. I don't want to get my fingers in too many pies, but I think that we've added hard money lending, which is complementary to what we're already doing.
Sure. Well, I mean, it sounds like you've done a great job. I mean, doing 2 big raises like that, and then some smaller raises is definitely a respectable feat that you've accomplished. So,
Yeah, it's more challenging. There's now that we've got a bit of a track record, it's actually more challenging finding the projects than raising the money.
Yeah, and I have heard that from people that have raised a lot of funds, is that they're looking for deals, not the other way. They're not looking for the funds. They've got that. They need the deals, and they need attractive deals that work. So,
yeah, my goal is to be a steady performer for my investors. I don't think we haven't taken the largest risks on the projects we've done. So I know a few people in the business who have perhaps risked more, bought properties that had more hair on them. And in this economy where things are going up, they've succeeded in making money on them. But I'm focused on hitting a series of base hits for my investors and being around through multiple cycles. So I think the investors appreciate that steady returns over many years is what seems to work for our investors.
Sure, absolutely. Well, this show, I want to talk about, building financial freedom for the listeners. So what's your definition to the secret to financial freedom?
That's going to be different for pretty much, that's going to mean different things to different people, obviously. Yeah. For me, I think that I don't know. There's always more to be done, but I'm close. I've got a business that's large enough where I can hire people, because there's no way that there's a rare person who enjoys doing every aspect of a business. That's what you have to do when you're at the startup stage, and it's hard to be good at sales and marketing and operations at the same time. So I've got a business that's just large enough where we can do a little bit of separation of powers. I've got some great people that work with me and for me, and it's paying the bills, and I'm able to save a little bit. So if things don't get any bigger from here, I think that I could live a happy life. I enjoy building businesses though, so there's more to come. But I think we've now reached the stage where the business is the engine is running, and it's not just me who's, another metaphor. It's not just me pedaling the bicycle anymore. We've got a number of people that are pushing the thing forward, and that's been rewarding to see.
So if somebody wanted to build that financial wealth or to build that business, where do they start? What would be your words of advice?
Real estate is an interesting place to be. It's complicated enough that not everybody does it, and yet there's still opportunities to start out small, so that if you want to do it, you can. If you've got, if you don't quit your day job, you can buy a single house, you can buy a duplex, you can probably get some money to finance it if you have a job. So start out small and grow from there. That's about the most profound thing I can say, is don't think that because you've got a full-time job or you don't have experience, that this is just this is insurmountable. I mean, I switched careers entirely from banking to real estate.
Yeah.
Did it in kind of a big way, but I started by buying one house. That was it. Go buy one house. Go buy a duplex, live in half of it, rent out the other half. There's enough opportunity here and enough small projects out here that I think most people, if they get over some mental barriers, can enter the business.
Yeah, I think that's great advice. I mean, you can always start small. and no matter what business you're in, well, maybe not no matter what, there's some
You can't
businesses.
run an airline small, for instance.
Right. But you can become a pilot first, or
Yep.
work for an airline first. But there's ways to definitely get in the corridor and started small.
Yeah. And there's just a ton of resources out there in the real estate world. It's really impressive.
Yeah.
Even if you're not ready to make a move, I would listen to podcasts like this. I did back in my banking days. I would go to the gym and I would have 3 or 4 podcasts on my phone and just listen to those.
Yeah.
Lots of books out there that are available. You can really soak up information.
Well, you led me to my next question. What's your favorite book? Business book or real estate book, either one.
It's been a while since I've read a real estate specific book.
Mm-hmm.
Some books that I've read recently are a little bit more focused on general business. There's a good one on negotiation. It's called Never Split the Difference by Chris Voss, who I believe he used to be a FBI negotiator. So negotiating through some very difficult situations, and he has some great negotiation advice. Podcasts, if you're looking for a catch-all, there's a podcast out there by Tim Ferriss, who most people know, the 4-Hour Work Week, the 4-Hour Body, etc. He's just got a good general personal performance improvement, sort of life hacking podcast where there's something in there for everybody. So I've listened to that, and I've started reading books that his guests have recommended. So I'm reading a biography on John D. Rockefeller Sr. right now, which is just a fascinating exploration of business that I didn't know much about.
Yeah, I do subscribe to Tim's podcast, so I enjoy that one as well.
Yeah, it's good stuff. You'll learn a lot from Tim, but his guests are fabulous.
His guests are great.
Yeah, you'll learn a lot from them too.
Well, Ian, I appreciate you being on the show. One last thing, if listeners want to reach out to you, is there any preferred way for them to contact you? Email?
Yeah, well, I've got, you go to our website and just send an email. There's an email address on there that comes right to me.
Okay.
So our website is carpathiancapital.com. So I'll spell Carpathian. It's CARPATHIAN capital.com. So Carpathian comes from a mountain range that's in the Ukraine and in Russia, the Carpathian Mountains. So carpathiancapital.com. You'll see a bio on me there. You'll see a link. You can send a message. I'd be happy to hear from you listeners.
Great. Well, Ian, I appreciate you being on the show.
Thank you. Thanks for the opportunity, Todd. It was a lot of fun.
Keep building mountains.
All right. Thanks. All right. Good luck to you as well. Take care.
Hey, special thanks for Ian for showing up and giving us great content and something great to work with for the show. 3 key takeaways I took, and one of them he didn't really specifically say, but I just think this whole story leans into it, is take risks, be willing to get out of your comfort zone. And where I took that from is it's very difficult to do a private money raise, especially when you're doing it like Ian did, where it's not based on a property specific. Most people don't start there, and that's exactly what he did. He started there. So I think that's huge. He took a big risk, but he understood what he needed to do to get his goals done. And that was the key, is he had a plan in place and a calculated plan. He understood what that was, and he was able to find the right people to back him on that. So he took a risk, and he didn't let fear basically stop him. So the next thing is trust but verify. And he talked about all his property manager, and he got taken advantage of, and other people did. And just how you need to, you need to trust people, but you also need to verify that you can trust them. And you need to have those checks and balances in place, and that system in place to be able to assure that everybody who is working, for you or with you is people that you can actually trust. So I think that's really important. And the last one is make sure you get in the corridor, right? Make sure that you take those actionable steps to get in the corridor, to learn what you need to do, and to take action steps to actually getting deals done and actually, starting your business. whether it's starting small or starting big right away, most people have to start small, but make sure that you actually get in the corridor and actually get started in the business. So again, special thanks to Ian for joining us on the show. I really appreciate it. Go on to iTunes and give us a 5-star rating and review. We'd love to hear what you think about the show, and we'd love to have you share this out on social media. Let other people know what we're doing and share the word. Help us grow our audience. I'm Todd Dexheimer. I'm signing out. Remember, make every day a Saturday.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.